All right. Now we're going to come into this very long example, and it is so long that even though it is one example, I have used the word S or examples, because it is actually multiple scenarios that we will discuss. Several examples, right, are there from real companies which are presented in this example, but I have used a plural because it is just so many examples that are part of this one example, which are showing very complex situations of revenue recognition. Now it's not even that complex. I can even give you more complicated situations, but we need to keep a focus on the exam, right? And the CFA Institute, of course, mentions that the exam is based on the curriculum, the examples and end of reading questions in the curriculum. So we are going to focus on the level of complexity that is there in this example, which is from your curriculum. The real world can get even more complicated, but for now we are going to focus on the example given in the curriculum. Now, first case study we are going to take is principal versus agent. Now, what does that mean? Before we get into this example, let me give you a different example so the concept becomes clear. Let's say there is Tesla, which is an electric vehicle company. Of course, you probably know about it. Most of us do, right? And then let's say there is a dealer, right? Or a sales agent. Now, this sales agent, let's say this is me. I am not actually buying the car. I am just trying to get customers for this car. So let's say I get a customer who is willing to buy it for 100,000 USD. Now, should I show this 100,000 USD as my revenue? The answer is no. Tesla is the one which is going to sell this car for 90,000 USD, and I am just going to get a commission of 10,000 USD. So my revenue is just 10,000. It is not the 100,000. The 100,000 revenue is actually for Tesla, of which they are going to give me 10,000 as commission, right? I am a commission agent. Tesla being the principal and me being the agent, right? So this is basically what is the principal agent situation, where the agent should only recognize revenue for the agency commission or agency income or agency fees that they are getting. They should not recognize the whole principal's revenue as their revenue. Now let's take the example from the curriculum. Mega Digital is an online marketplace that sells goods and delivers them quickly to customers. For some sales, they are the principal, and for some sales, they are an agent. Now, what does that mean? When they are the principal, they control the product before the goods are transferred. So here, Mega Digital first buys the product from the supplier, and then later it sells the product to the customer. It is taking ownership, it is taking control of the product. But in other situations, Mega Digital is doing something called drop shipment, right? Which some of you, if you have background in e-commerce sales, will understand that they are not actually taking, Mega Digital is not taking control of the product. They are just directly getting the product transferred from the supplier to the customer. In which situation, the principal then becomes the supplier, right? And here principal is PAL. This is not the principle of accounting recognition. That is a different principle, and this is a different principle. Here we're talking about that who is the owner of the product. And in the second case, MD is just, or Mega Digital is just an agent, and the supplier is the principal. However, in the first case, Mega Digital is taking ownership or control of the product, and therefore Mega Digital is the principal. So clearly, in the first case, Mega Digital will record a much larger revenue, and in the second case, Mega Digital will record only the commission that it is going to generate from facilitating the sale between the supplier and the customer. So as discussed, in the transaction in which Mega Digital is the principal, they will record the total amount of revenue, and in which they are an agent, they will only record the portion of its fee or commission. And definitely it's going to have a huge impact on its financial statements. Now, what does common size and ratio analysis mean? We will discuss at the end of this learning module. But since it's mentioned over here, I'll just tell you that let's say if I am comparing two companies, Mega Digital and Amazon, and they are both online retailers, and Mega Digital is showing all of their revenue, whether it is through principal or through agents in their revenue, then their revenues will be looking much bigger. And if Amazon is showing all their revenue as agent only, even though for many products they are keeping themselves in the middle as principal, so their revenue will be showing much lower. And if I will do an analysis of their revenue to their gross margin, right? So the ratio, let's say if I want to compare their gross margin or gross profit percentage, which is basically your gross profit over your sales, then it will be completely different, because Mega Digital will have much larger sales, whereas Amazon will have much smaller sales, but they will have similar gross margins, and the ratio will be very different. And common size also, this is something we discussed in the previous learning module, that we look at everything as a percentage of total sales on your income statement, and we look at everything as a percentage of your total assets in your balance sheet, and that is known as common size. So again, if the sales figure is very large, then all the percentages will look very small. And if they record everything as an agent, the revenue will be lower, but profit margins will be higher. And if they record everything as a principal, sales will be higher, but profit margins will be lower. And you can see that from these two examples, that let's say they are selling a product as a principal for 100 and the cost was 70. So their gross profit will be 30. Whereas if they are doing it as an agent, right, they will not show the 100, they will not show the 70, they will just show that 30, which is their commission, as the sales. Okay, now many e-commerce companies do this. For some products they are taking control, for some products they are not taking control. And we as analysts really need to dig deep into this to understand what percentage of their revenue is coming from a principal based activity versus what percentage of their revenue is coming from agent, because we need to forecast, we need to project, right? We need to predict their sales and margins. And this is very, very important if that mix is expected to change, the principal versus sales agent mix. Okay, now let's move on to another example, and here we're going to look at a franchising versus licensing business. So this pizza company, it is both operating as well as franchising pizza delivery restaurants around the world. So let's say this is Mahjong Pizza, and let's say in country A, they have their own outlets, right? They have their own outlets. But in country B, they are not having their own outlets. They are doing a franchising model. Now the sales from their own outlet, of course, they will recognize as their revenue. But the franchisee is going to be paying to them something called royalty fees, which let's say is 5.5% of the sales, right? So for Mahjong Pizza, for their own outlet, 100% of the sales will be their revenue. But for the franchised outlets, only 5.5% of the sales, which is going to be paid to them as royalty fees, is going to be the revenue. Plus the one-time fees that the person or the company which takes the franchise will also be recorded separately. And remember the matching principle. So royalty fees will be recorded when the sales is done. This sales, which is from their own outlets, will be recorded when the sales is done. But this one-time fees, it's probably going to come in the beginning when the franchise is there, but this is not only for 1 year. This is for a long period of time. So we might need to break this one-time fees up over, let's say, 10 years and record it slowly, right? Just to make sure that the matching principle is there, that these revenues should be recorded for the whole period where they are relevant for. And why is this important? Why are we as a company required to show all of this? Or rather, why as we as analysts want to see all of this from companies? Because we want to be able to understand this company's revenues in all its different breakups, so that if we expect country A to do well, then we will think that these revenues will do well. Or if we expect country B to do well from a macroeconomic high level analysis perspective, then we will expect these revenues to do well. So we want to know all the different revenues and how they are affected by different economic factors. That's why the breakup is very important. And the company might not want to give it, but because of the accounting standards, they will have to give that breakup to us. So now with this Mahjong Pizza, they will tell us for their company-owned stores revenue separately, they will tell us for their franchise and royalty fees separately, and they will tell us for their supply chain revenue separately. Now, what is supply chain revenues? This is basically, let's say, I'd rather take a different example. Let's say we're talking about Domino's. And in the US, maybe they have their own operated stores, right? And let's say in country B, they are having a franchise. Now, franchise is paying them royalty payments, right? And one-time fees, which we already discussed. So that is there as well. But also, Domino's is probably selling them some flavors, some, just ingredients that they use. So that is where the supply chain revenues are going to be coming in. So company-owned stores, obviously all of the sales will be shown in Mahjong or Domino's, whatever you like to call it. And the franchise and royalty fees are from your franchisees, the third parties. They will be paying the 5.5% of the revenue. The upfront fees for opening new units, this has to be recognized across the number of years. If they're taking the franchise for 10 years, then we will divide that across 10 years. And the supply chain revenue, sales of food, equipment, supplies will be recognized as those equipment and food products are delivered to country B based on the shipping terms. Now, what does this mean? There are delivery could be on destination, or it could be on the shipping port, right? So as soon as, let's say the shipping port is US or New York, right? Or destination port, let's say, is Mumbai in India. So either the terms could be as soon as it leaves New York, we're going to recognize the revenue, or when it reaches Mumbai, we're going to recognize the revenue. So depending on whatever shipping terms is, the revenue can be recognized. All right, another example, software as a service or license. Now here what happens is there's a very popular business going on which is called software as a service, right? And the other type of business is, of course, selling license. So let's say we are talking about, let me take another company instead of this Cream software. Let's say we're talking about Oracle Financials. Now you've opened your business and you need an accounting software. Let's say you're going with Oracle Financials. Now you could rent Oracle Financials, which is your software as a service model, that as a service you're getting this software. Oracle is just going to charge a monthly fees, right? Monthly rent, and you could just get a username, password. The server obviously will be provided by Oracle, and you'll just use it and pay the monthly rental. On the other hand, you could say, no, I don't want this software as a service model. I'm going to pay you a one-time cost, and you'll just give me the rights for this software, and I will install the server at my end, and I will use it for, let's say, 10 years. You can give me a license. Now the question is, how should Oracle recognize this revenue? One thing they can do is, if you're going for the software as a service model, whatever monthly rental is due, they will recognize the revenue of that, and when you pay it, they will be setting off that accounts receivable and receiving the cash. So they could go about the software as a service model very, very easily on a monthly basis, as the revenue is recorded based on as the service is delivered to you. However, little bit complication is there with the license. Now, if you pay upfront and you buy the 10 years license, Oracle can recognize that whole revenue at once, or it can divide it across 10 years. Now, what is the detail for this, right? If, for example, Oracle is agreeing to maintain this software that they are giving to you, that means there is a certain service that Oracle will be giving you over the 10 years period. In that case, they should divide it across 10 years. However, if they are not undertaking to maintain that software, they have given you a certain version, and that version is what you have bought, right? You're not getting updated versions, you're not getting updated service. So in that case, if they've sold you a particular version and you can use that for 10 years, then Oracle can recognize that revenue as soon as the sales is done. Now, practically speaking, what happens is that this will be done in two parts. So there will be a certain portion that will be recorded at once for the whole 10 year, and the support payments, if you choose to get the support, then the payments will be made separately, and the revenue will be recorded across 10 years separately. So usually with these technology companies, what we see is that they will sell you the software and record the revenue upfront for one particular license, and separately they can charge you for support and record that revenue over the course of the contract. Or of course, the simplest model these days, and very, very popular of course, is your software as a service, where you keep paying monthly or yearly rentals, and that is how the revenue is recorded. So what does the accounting standard say about this? IFRS 15, that if you are going to be keeping the software up to date in terms of upgrades and enhancements and all this, then you should record the revenue over the term of the license, right? So if it's a 10-year thing, then you should break up that revenue and slowly record it if you're doing some kind of upgrades or enhancements, right? And the customer could be positively or negatively impacted by that. So hence, there is not a transfer of good that is taking place. It is, you are giving them a continuous service over 10 years, and that's why you have to record the revenue over 10 years. And in this particular company's annual footnotes, they have said that, okay, we have these software revenues from the sale of licenses, right? And they are generally recognized at a point in time when the software is made available to the customer. So that means they are not dividing it across 10 years. They are recording it as soon as the delivery is done. That means they will have a separate revenue stream for the updates and support. And that's what they're saying over here. Revenue from software support and updates is recognized as the support and updates are provided. So this is what they are doing. And this is very, very, very common as well, that they are saying, okay, the license we are selling you separately, and that we are recording at the time of the sales, and the updates we are going to provide you separately, and let's say for a 10-year contract term, so that we will recognize on a pro rata basis. So that's where this ratably word is coming from. This is coming from pro rata, which basically means equally or as incurred, right? So it will be equally distributed across the contract term. So the software is sold as is and revenue is recognized at the time of the transfer. However, for the support contract, it is recognized over the contract term. And they have disclosed that as well, that for customers who are going for the SaaS model, right, without taking possession of the software, they will just recognize that revenue over the contract term as they are using that service. Agreements are non-cancelable and do not contain a refund type provisions. Even so, think of that $100 into 12 months. When you can't get out of that contract, you've already agreed to pay the $1,200, but the company is only going to recognize the $800 for the phone, but the remaining $200 of the data and $200 of the calls, they will only recognize as the service is delivered, right? So similarly, for the software company also, as the software is used, they will keep billing. And finally, another interesting example, which will be broken up into two things: long-term contract and another one which is holding the equipment but you're still billing for it. So let's discuss one by one. First, the long-term contracts. Is your armored vehicle incorporated? Now what these guys are doing is they are entering into long-term contracts with the military and providing a service which is not only extended over several years, but there is a performance that is delivered over time. It's not a one-time thing. It is a continuous maintenance that you are providing, right? So here again with the IFRS 15, that if the customer is receiving and consuming the benefits simultaneously, right? Routine service contracts. And think of telecommunication equipment as well, right? That they are providing the data and you are using the data. They are providing the minutes, you are using the minutes. So they are receiving and consuming. It's not like you can get the data before and then use it later. The minute you are using it, that is when you are receiving it. So these type of products and services are going to be spread across the contract period because it is an ongoing sort of a performance obligation. And as the performance obligation is completed on a continuous basis, the revenue is recognized. It's not like you can just create something and hand it over, right? It does not create. So because this performance obligation is satisfied over a period of time, definitely the revenue will also be recognized over a long period of time. So therefore, they recognize the revenue for their long-term contracts over time as these products are continuously transferred to the customer. And this is a very special case that, of course, and it was, as was previously mentioned in this slide as well, that this product you cannot give to another customer, right? This is for this specific customer. It is, let's say, for the US military. So then definitely they are going to be recognizing this revenue over time, and they will not be able to just recognize it once and for all. Now, little bit different concept is there, which is the difference between input approach and output method. So there is an input method and there is an output method. Before I jump into what this example is saying, I want to give you a parallel example. And I like to talk about building construction, right? So as you might know that when you're making, let's say, a building and it has multiple floors, majority of the work actually is done when you have to dig and make the foundation, right? And in terms of the cost, maybe 50% of the cost is going to be incurred in making the foundation. Let's say 40% of the cost will be in making the foundation, 10% of the cost will be making the first floor, and the remaining 60 minus 100 is 40% is going to be for the rest of the floors. Now, so if we were doing the output method to recognize revenue, we would say, okay, as the first floor is done, and let's say we are making 1, 2, 3, 4, 5, 6 floors. So from the perspective of the output method, we would say, okay, first floor is done. We're going to recognize 1/6 of the revenue. But that would be unfair because in terms of our cost, 50% of our cost has been incurred in just completing the first floor because 40% has gone into making the foundation. So some companies don't prefer to use the output method as the method to recognize revenue. They want to go for something known as the input method, where what you could do is you could recognize revenue as a percentage based on the cost incurred. So let's say the total revenue we're going to be recognizing for this business, total revenue is, let's say, $100 million, right? And once the first floor is done, what we will do is that we will take 40% and 10%. So 60%, or let's say, let's talk about it in millions, that our expected cost is expected to be $80 million, of which 30 million is expected to be in the foundation, 10 million is expected to be in the first floor, and then the remaining 40 million, let's say, is going to be in the rest of the floors. So how much will have been incurred in the foundation and the first? The 30 plus 10 of a total of 80. This much multiplied with the total revenue of 100 is what is going to tell us how much revenue we can recognize once we have finished with the first floor and the foundation. So just to make sure you understand the concept, now let us go through the example which the curriculum has given. That here they want to talk about going for a cost-based revenue recognition, where we will take the cost of sales, we will recognize it as it is incurred, and the revenue will be recognized based on a proportionate amount of the estimated cost of sales, right? And let me show you. So let's say they have a total revenue of 10 million, right? So this is the total revenue they are going to recognize, and the total cost is expected to be 7 million. Now, in year 1, 4.2 million of the cost is done. So 4.2 over 7 is going to be multiplied with 10, and this gives you 4.2 divided by 7 multiplied by 10. So you're going to recognize 6 million of revenue in the first year, right? And similarly, the profit will be in the same percentage as well. In the second year, another cost has been incurred. Now look, the total cost was expected to be 7, but there has been a cost overrun, right? 7.5 million of the cost has been incurred. But the total revenue will not change. It's not like just because your cost has gone up, your revenue will be higher than 10 million. So from that 10 million, already 6 million you have recognized in year 1. So now you can only recognize 4 million more, and that is what you will do, right? Now there could be a lot more complexity over here, but I'm not going to go into that detail because we'll just stick to the level of detail provided in your curriculum. Okay, finally, bill and hold arrangements. Now what's happening over here is that they are producing these tanks, custom made armored vehicles, and they're not giving them to the customer because the customer, let's say, doesn't have a space to store. So there's a lack of storage space with the customer. But they will be able to bill because your standard allows this in certain circumstances. And what are those circumstances? They're mentioned over here. Number 1, that the customer has asked you to keep the equipment or whatever the product is at your site. It's not that you are doing it on purpose. The customer has requested to you, and you are not just keeping it mixed with all your other goods. You're separately identifying in your warehouse that these goods belong to the customer. And any given point in time, they are ready for physical transfer to the customer, right? And you cannot give it to any other customer. If all of these criteria are met, then you can recognize that revenue, you can bill it and hold it for them. So in this case, of course, it's a very unique vehicle. No other customer wants it, or even if they want it, you cannot give it to them. You're just holding on to it. So you're just waiting for the delivery and it is ready to be delivered. So in this case, AVI can recognize this revenue. And finally, all of these details have to be disclosed, right? So as an analyst, when you are studying a company's financial statements, you really need to get into the details and understand what is all the business going about in that company, what are the different geographic regions, type of products, services, type of customers, any kind of terms, right, that might be there. What are the judgments that the accountants are taking in terms of performance obligations? What are the transaction prices for each of those performance obligations, right? And then you can look at the unearned revenue in terms of the liabilities, the accounts receivable in terms of the assets, and get an understanding of, are they doing aggressive accounting, are they doing aggressive revenue recognition, what are the different sources of revenue, what are the economic expectations that you're having of their different countries in which they operate, and how you feel the projections will be. So easier said than done, but you're just at CFA level 1 now. So just get the core concepts in place, and of course you can build on top of them over the next over your studies for all 3 levels. So we're going to stop this video here, and in the next one we'll pick it up with expense recognition.